over the course of the last 12 months, we've now had major banks come out and recommend a portfolio allocation change for the first time in 25 years. Standard portfolio recommendations from companies like Bank of America, Goldman Sachs, Morgan Stanley have been 60-40, 60% stock, 40% bonds. Bank of America was the first one to come out last year, a year ago now. They came out and said, take the 40% bonds and swap them for commodities. The reason they highlighted bonds, the yields will fall as rates fall. At the same time, commodities will surge in price because the dollar will fall as rates and yields fall. And so they recommend swapping those bonds for commodities because they will give you larger returns over the next 5 years. They didn't come out and highlight gold specifically, at least on the Bank of America end. However, they highlight gold and silver are the top performing commodities. On the other side, we had Goldman come out in June, and Goldman directly came out and recommended swapping the 40% in bonds to gold. They highlight that as gold will provide higher returns they see than bonds. Same reason as Bank of America over the next 5 years. Now, lastly, and this is another new development, Morgan Stanley, same thing. They're recommending a switch from the 60-40 portfolio. Instead of recommending 60-40 being in commodities or 40 being in precious metals, they're recommending what they call a 60-20-20. 60% stock, 20% oil, 20% precious metals. Now, the one thing I do want to highlight, you'll see oil and gas can be an extremely risky endeavor. And in most cases, it's reserved just for accredited investors. And so the one thing I would highlight is you need to make sure you really consider your investment objectives, but more so your risk tolerance before you make these allocation moves. In addition, I want to raise the question because people need to think about it for themselves. Why are the banks coming out and recommending allocation shifts, right? And despite what most people may think, it's not because they want you to make the most amount of money. Remember, banks in general, they don't sell physical gold and silver. You can't buy it from them. So, you have to ask, why are they making the recommendation? And the reason is for liability's sake, right? When banks come out and make these recommendations, the reason they're making the recommendation, we just saw what the Buffett indicator says. We just saw we're in a commodity market boom and that rates are falling, right? They want to come out ahead of this thing and warn people and tell people that this is what they're doing, right? Because when bond yields crash, when we see the market come back, they don't want anyone coming to them and potentially taking legal action because they lost money. So what they're doing is they're telling everyone that this is what they recommend now, just like the Fed is coming out telling everyone this is what we're doing with interest rates. There's going to be no surprises because on the back end of this, what they're going to do is tell all their clients, well, see, we told you so. And that's why they're making the recommendation is really a liability measure by them.